In this video, we're going to go through the Chapter 8 examples for business finance. So we're talking about capital budgeting, and we're going to look at the capital budgeting examples for calculating the different methods to evaluate capital budgeting projects. So we're going to start with the payback period. So when the payback period cash flows are equal or the same exact every year, the payback period is the initial investment divided by the cash flows. If the cash flows are not the same exact value every single year, then we have to do a different method of payback. So we have to add each year's cash flows until we have paid off our initial investment. So we're going to take year 0. Remember, year 0 is the initial investment. That's when our project starts, and then our cash flows start in year 1. So this is day 1 of our project, and this is at the end of the first year of our project. So we're going to take our initial investment and add the cash flows from year 1. At the end of year 1, we still need to make $4,700 in order to pay back this project. So we will take the value at the end of year 1 and add the cash flows from year 2. At the end of year 2, we have $1,500 left until we pay back this project. In year 3, we are going to make more than $1,500. So we know that this is going to be paid off sometime in year 3. So to calculate the exact time in year 3 that this will be paid back, you take what is left at the end of year 2 and divide it by the cash flows from year 3. So we're going to take $1,500 divided by $2,200, which is the year 3 cash flows. So we get 0.68. So the payback for this project is 2 years and 0.68. So 2.68 years. In this example, we're also calculating the payback period, but now we have even cash flows. So when we have the same exact number of cash flows over a period of years, we just take the initial cost divided by the cash flows. So when we're looking at the payback for $3,100, we take $3,100 divided by the cash flows of $865. If this project cost $3,100, we will pay it back in 3.58 years. If the project costs $4,300, it will take us 4.97 years to pay it back. And if the project costs $7,900, it takes 9.13 years to pay it back. This we would actually also say as never, because it's not paid back within the 8 years of the project. The project is only 8 years, and if it takes us 9 years to make the money back from it, then the project never pays for itself. Whether or not we decide to take on a project depends on what the company's threshold requirement is for payback. If the company says they'll only take projects that are paid back within 4 years, then this first project would be accepted and the second project would not be accepted. The third project would never be accepted under any circumstances. In this calculation, we're looking at the average accounting return for a project. So the average accounting return is method used in capital budgeting. It's also sometimes called the accounting rate of return, and there are multiple different ways to calculate it. So we've run into that in a couple of other chapters where there's 3 or 4 different ways to calculate something and no real agreement on which one is the best way. So when we run into multiple ways to calculate something, we use whatever our textbook is using. So our textbook uses the average net income divided by the average book value. So we would take our average net income, which is the sum of all of our cash flows, divided by the number of years for the project. And the average book value is the cost plus the salvage value divided by the number of years divided by 2. So we have a cost of $10,800,000. If we look at our information, we see there's 0 salvage value. The project is for 4 years. So we're going to take the cost divided by the number of years divided by 2. Now we can calculate our average accounting return, which is the average net income divided by the average book value. Whether or not we decided to accept this project would depend on the company's threshold for deciding based on the average accounting rate. If they said it had to be above 20%, then this would be a good number. If they said it needed to be above 30%, then this would not be an acceptable project. In this example, we're looking for the internal rate of return. When we have uneven cash flows, you can use Excel or a scientific calculator or financial calculator to calculate internal rate of return. If you try to use a mathematical formula or a handwritten formula, you have to use guesses and recalculate it until you get as close as possible. So the only way you can get just the exact answer is to use the internal rate of return function in Excel. So we use IRR is the formula for internal rate of return, and we select all of the values. You can ask Excel, you can put in a guess, but you don't need to. So we're just going to close the formula. So the internal rate of return on this series of cash flows is 16.26%. The internal rate of return decision rule is that if the internal rate of return is higher than the company's required rate of return, you would accept the project. Now we're going to calculate the net present value, and we're going to use the same number of cash flows, and we're going to calculate the net present value of a project at 2 different required returns. First, we're going to look at the time value of money table calculations, and then we'll use an Excel formula. So we have year 1, 2, and 3, and we want the factors for 9%. So we can see here we want the present value of 1, so make sure that we're using the right factor table, and we want 9% for 1 year for the first year cash flows, so 0.917. And for year 2, 0.842, and year 3, 0.772. Okay. We take the year times the factor, we add these together, and this is the present value of our cash flows. To get the net present value of the project, we add the present value of our cash flows to the initial investment. Okay. We can check and see if our table has 21%. I'm not going to try to. So then we can use the net present value formula in Excel, which is NPV, the rate, 9%. Then with the internal rate of return, you select all of the values. For the net present value, you only select the cash flows from the years of the project. We close the parentheses, and then we add the initial investment. So we'll do that at 21%, the net present value at 21%, select our cash flows, and add the project. So we can see at 21%, the required rate of return gives us a negative present value. In this example, we have the net present value for a series of cash flows that are identical. So if we're going to use the factor table or the present value table, then we want the present value of an annuity. So we have a project of 8 years and a required return of 8%. So let's look at our present value table, 8% for 8 years. Oh, present value of an ordinary annuity. 8% for 8 years is a factor of 5.747. So our factor is 5.747. And if we take our cash flows times the 5.747, and then let's put plus the initial cost. We get a net present value for the project of 8% of $5,627.14. If we do the present value of the cash flows, the rate, it's 8 years, and then we want to put a negative before the payment. There is a 0 future value, and it is an ordinary annuity, plus our project. So you can see that we're very close. The difference is the rounding in how far out we take the factor. At 24%, 8 periods. Remember to put a negative sign in front of the cash flows. Future value is 0, type is 0. Add our initial investment, and that has a negative net present value. So we would reject the project with a negative net present value. The internal rate of return for this project have to use the rate formula because we don't have all of the cash flows listed out. If we listed out all of the cash flows out year 1, year 2, year 3, then we can use the IRR formula. But we use the rate formula to calculate the rate. Our payment, the present value, the future value is 0, and the type. and we get an internal rate of return of 22.19%.